Welcome to the Advisory Group's economic update at the end of the second quarter for 2026. Let's first start with some introductions. My name is William Glenn. I am a Client Services Associate with the Advisory Group. Our primary speakers today are Brent Beverly, the President of the Advisory Group, and Manny Chinche, a Senior Advisor at the Advisory Group. Joining us today but not speaking is Chris Lee, the Vice President of the Advisory Group. All three of them are certified financial planner practitioners and wealth advisors. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make an informed decision. Our contention is that the more you know how things work, the more you will enjoy working with us. We want you to know what is going on. As a reminder, it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Today's presentation will be focused on investment planning. To get us started on the core of our workshop, let me bring up our first speaker, Manny Chinche. Manny?
Thank you, Will. The second quarter of 2026 demonstrated an important lesson for investors. Markets can continue to advance even when uncertainty dominates the headlines. Persistent inflation concerns, heightened geopolitical tensions, high energy prices, and evolving expectations for Federal Reserve policy all contributed to periods of market volatility. Despite this, however, U.S. equities recovered from a difficult first quarter. In fact, equities once again reached new highs during the second quarter. So after a down first quarter, both the S&P 500 and the Dow Jones made impressive rebounds. The S&P 500 closed the quarter at 7,499, up 14.4%. The Dow Jones Industrial Average closed the quarter at 52,319, gaining approximately 12.8% for the quarter. Equities are long-term investments. As this chart here on your screen illustrates, even with downturns, long-term investors have stayed in the market over 10, 20, 30, or 40 years have historically been rewarded with considerable gains. Despite market pullbacks, as you can see, stocks have risen considerably over the long term. Now, volatility is a part of the investment experience. Just look at this chart. Downturns and corrections are common, and therefore your investment strategy should account for that. Historically, U.S. stocks have experienced on average 3 downturns of 5% per year, 1 correction of 10% every 2 years, and 1 correction of about 15% every 3 years. Now, we expect volatility to remain prevalent in the coming months, so we recommend that investors be prepared with a well-diversified long-term financial plan. The last 3 years have rewarded long-term investors, and as we said earlier, 2026 started on a volatile but upward note. We again emphasize that you need to understand that investing in equities is a long-term commitment. Just because returns have done well, this is not the time to become complacent or make risky decisions. Now, we believe that volatility could still be prevalent and that investors should be cautious when making financial decisions. Again, a long-term strategy should continue to be the benchmark for smart investors. According to IATA safety reports, historically, commercial airline crashes are extremely rare. They happen in roughly 0.00013% of flights, which is 1 out of 1.32 million flights. Now, that means you would need to fly every day for over 55,000 years to experience a fatal accident. However, on every flight before takeoff, they prepare you for a problem, and odds are on a long flight at some point the pilot may have asked you to take your seat and fasten your seatbelts. Now, media stations need viewers, and nothing drives them better than fear. That's why as the markets have rough days or patches, you might hear things that arouse your emotions. Now, emotional investing has never been the best choice, so let's review some helpful thoughts in advance. Media may say, watch out for a market correction. In fact, the question on many investors' minds is whether we could experience a market correction. Now, we actually had a correction in April of 2025, and from a historical perspective, it is reasonable to expect that markets could experience a correction, which is defined as a drop at least 10% or more at some point in 2026. Now, this happens on average about once every 2 years. Please also keep in mind that according to analyst estimates, most major institutions believe that equity markets will be higher by year end. Now, market corrections can feel unsettling. They are a normal and healthy part of long-term investing. Corrections help relieve excess speculation and allow market valuations to reset after periods of strong gains. As many analysts point out, they're not necessarily something to fear. Now, our goal shares perspective is to help set expectations. If markets decline and you have concerns, we encourage you to contact us before making any changes. We're here to help you navigate market volatility with confidence. Now, most strategists continue to forecast solid earnings growth for 2026. Against that backdrop, markets may continue to move higher over time, even if there are periods of short-term volatility along the way. Now, as you can tell, we believe the volatility is likely to resume at some point in the future. That said, last month in June, several of the leading investment firms raised their expectations on where they expected the S&P 500 to finish this year. As we showed in an earlier slide, the S&P 500 closed on July 14th at 7,543. Each of these major Wall Street firms here on your screen is expecting the S&P 500 to end the year even higher than where it is now.
Well, thank you, Manny. Now, we like to check up on how inflation is doing. Inflation is clearly something investors need to pay attention to. And according to the May data, a little older, from the Bureau of Labor Statistics, the Core Consumer Price Index, the CPI, which excludes food and energy, increased 2.9% year over year. Food prices rose 3.1%, while shelter costs, the largest component of the CPI, increased 3.4% from a year earlier. Now, at their June meeting, the Federal Open Market Committee brought out their updated inflation forecasts. Back in March, Fed members had projected that the Personal Consumption Expenditures, PCE, price index would end 2026 at an annual rate of only 2.7%. By June, that estimate had been revised upward to 3.6%, almost a percent higher, while core PCE, which excludes food and energy, was projected to finish the year at 3.3%. Now, the Federal Reserve is still looking to have an inflation rate of 2% or less. However, this may not be accomplished for some time. So inflation numbers are a subject we need to continue to watch closely. Now, energy prices affect the price of nearly everything, from the cost of goods to the gas pump. Now, as you can see from our graphic here, the national average gas price in May climbed above $4.50 a gallon, with states like California, where we're based, over $6 a gallon. Now, rising fuel and energy costs have contributed to heightened volatility and uncertainty across the equities market, largely driven by ongoing supply disruptions and geopolitical tensions in the Middle East. Can you say Iran? Okay, yeah, the Gulf of Hormuz. All right, that's what's driving this. Now, many investors remain hopeful that prices will begin to stabilize and return to more normal levels once the conflict involving Iran is resolved. Now, the cost of borrowing remains high. Their average credit card interest rate as of May 2026 was 19.57%. While this is still very high, it is down from the record high of 20.79% set in August of 2024. Now, this means if you can avoid incurring credit card debt or financing items, you can save yourself quite a bit of your hard-earned money. Pay off the credit card. During the first half of 2026, the Federal Open Market Committee kept its benchmark federal funds rate unchanged at all 4 of its meetings, maintaining the target rate at 3.5 to 3.75%. Now, looking ahead, based on their current meeting notes, the prospect of a rate cut in 2026 looks increasingly unlikely. In fact, the possibility of a rate increase later this year has gained momentum. The path forward will largely depend on the trajectory of inflation, labor market conditions, and overall economic growth. Interest rates remain a critical factor in financial planning and in the investment decision making. Now, we'll continue to monitor this important economic indicator closely and we'll provide you with updates as changes evolve. While we've seen the yield curve resume its traditional curve, we're still seeing interest rates slide up. Treasury yields remain elevated as investors continue to consider the prospect of higher for longer interest rates. As the quarter ended, the 10-year Treasury yield was 4.44%. The five-year Treasury yield was 4.19, and the 30-year Treasury yield was at 4.91. So bond behavior continues to hinge on the direction of interest rates. Early in the year, the Fed had anticipated potential rate cuts in 2026. But to date, we've not had a single one, and at the last Fed meeting in June, the sentiment was a much more hawkish turn, and whether or not we'll see interest rates cut this year. More likely, at this point, we're likely to see a rate hike sometime in the fall. Now, should the Fed pursue rate cuts, existing bonds would appreciate in value. Conversely, expectations of slower easing or persistent inflation pressures could push yields higher and thus bond prices lower. Though expectations for the timing and pace of future interest rate adjustments continue to shift, treasuries and bonds can remain an important component of a diversified investment portfolio. They may offer relatively less volatile alternatives to equities, particularly during periods of heightened market uncertainty. At the same time, the possibility of rising interest rates could create price volatility for existing bonds. Might want to hold on to maturity or plan to hold on to maturity. So please remember that while diversification in your portfolios can help you pursue your goals, it does not guarantee a profit or insure against a loss. As market fluctuates, some people still run to the supposed safety of bank accounts. Now, safety comes at a cost, and sadly, many major banks are still only offering low interest rates to savers. According to Barron's, the average bank money market rate on June 29th, 2026 was a whopping 0.51%, 0.5%. The average 12-month CD rate was 1.94. Now, if you're interested in exploring sources for better interest rates, please be sure to contact our office. And when you net these rates after taxes and after inflation, what we really find is that your return is typically negative, what we like to refer to as going broke safely. Now that helps bring up our topic here of watching your taxes. One of our goals as a holistic wealth management team is to help keep our clients informed of any tax laws that may affect them. We love helping our clients, and we love helping reduce their tax bills too. So as we get closer to the end of the year, we will be providing you with updated information on proactive tax strategies, including provisions of the One Big Beautiful Bill Act, the OBBBA, that got passed last year. Now to close this out, please allow me to bring back up Mr. Glenn. Will?
Thank you, Brett. Looking ahead, we remain cautiously optimistic. Although volatility is expected, the combination of healthy corporate earnings and a resilient economy provides a supportive backdrop for investors as we move through the remainder of 2026. In summary, uncertainty and volatility remain and are likely to be here for a while. However, equities continue to be resilient. Strong corporate earnings, a reasonable U.S. economy, and continued enthusiasm for artificial intelligence, AI, and technological innovation all help drive broad-based market returns. The Federal Reserve kept interest rates unchanged. They remained at 3.5 to 3.75%. However, Their notes now show that the Fed is taking a more hawkish approach to interest rate changes for the remainder of the year. Inflation numbers remain inflamed, particularly due to the energy sector and oil prices. Treasury yields remain elevated as investors continue to consider the prospect of higher for longer interest rates. We will continue to monitor key items that could continue to fuel volatility, including oil prices, the path of inflation, and interest rates and geopolitical uncertainty. Focusing on your long-term goals and staying the course with a well-guided plan can help you stay grounded and confident during these times of uncertainty. Remember, we are here for you. Please reach out with any questions or concerns. Your financial well-being is always our priority. Please pause your screen and read through these important disclosures. If you want to reach out to us, here's our contact information. We're thankful for the opportunity to assist you with your financial needs. Remember, at our firms, clients come first. Your health and well-being is always our highest priority. One of our major advantages as a financial advisory firm is the advisory group's team, what we like to refer to as our TAG team. We're proud of our TAG team and the high quality of service we all provide. You may notice some new photographs here. Our TAG team keeps growing. Here again is the information for you to reach us. We're glad to be of service. Please reach out to us if you have any questions, comments, or want to meet with us. Have a wonderful day, a great year, happy, healthy, safe, secure, and prosperous.